The Street opens in the green following bullish global cues. Nifty rises above 24,500. The Nifty bank bounces back. Autos and metal stocks lead the gains.
Adani Ports is higher in trade on the back of a strong showing in the fourth quarter numbers. The EBITDA rises 24% from a year ago. The profitability as well jumps up.
Maruti trades more than 3% higher after a good session in the previous trading session as well. April auto sales come in slightly better than estimates. Total sales rise 7% year on year.
Industar slips only 5% despite a good fourth quarter as the lack of dividend disappoints the street.
A bunch of other stocks in focus. PNB Housing Finance climbs after nearly 1.7 crore shares exchange in a block deal. Nuvoco Vistas rally 6% after record volumes in the fourth quarter, whereas Go Fashion too surges on the back of strong fourth quarter numbers.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as you could see, shortly we'll have on the top of the screen, yes, we have the green on the screen, the Nifty Bank, the IT index, and the breadth of the market as well. Things looking good. Let's see whether or not the bulls can go into the weekend on top.
They should, Nigel. You know, all check boxes are being ticked. Yeah. The Nifty is doing well. It's being led by the autos. The banks are doing a lot better after having underperformed, and the broader markets as well. More stocks advancing than the number of stocks which are declining. The only thing which is better is that tomorrow is a holiday. Yesterday was a holiday as well. But a bunch of companies on our radar. First up, we have Skipper. The company posted an overall good set of numbers in the fourth quarter. They reported their highest ever quarterly revenue and profit. And this is after a sharp uptick that they got, or rather ably aided by the uptick in their other income as well. Sharan Bansal, who's the director of Skipper, joins in to discuss the quarter gone by in more detail. Sharan, let's start with FY26, the basics. You know, FY25 saw a revenue growth of 41%, record revenue coming in from both engineering and polymer segment. What is your guidance in terms of revenue and margins for FY26 from where you look at things right now?
Hi, Mangalam. Yes, we've definitely had a very good year and quarter. Back in FY23, we had taken on a target to double our revenue in 3 years' time, and I'm happy to report that we have been able to achieve that in just about 2 years. Going forward, even on this elevated base, we feel there are very, very strong opportunities available in the market. The company is carrying an order book of 7,000 crores plus. So based on the order book, looking at the market opportunity as well as our capacity expansion, we feel that 25% revenue growth from here on as well, and for the subsequent years also, should be very much possible.
Okay, 25% plus growth. Congrats, Sharan. I recall speaking to you a couple of years ago or so, and at that point of time, you had put out big guidance. And as you're saying, you're maintaining that. So good on you. But let's get a couple of more details. Profitability, is still hovering around that 10% odd mark. Should this be the range that we should be working with? And the other positive, that I would like to highlight besides the revenue growth in your numbers is that the working capital days have come down. Is it sustainable? Can it get even better?
Very good point, Nigel. And yes, the profitability, we do expect that there's headroom to grow. One reason is that we are going to see much more revenue coming from T&D now than our non-T&D revenue. Non-T&D historically has been a lower margin business for us. So both in terms of bottom line as well as working capital, we expect the coming year to be even better than what we've delivered. On the working capital side, yes, we have made some improvements. There are certain more optimization that we can achieve, both in terms of inventory as well as working debtor number of days.
So can you talk about the margins? I mean, how much more can margins improve? And since you spoke about T&D, what is the contribution of T&D to your revenues right now? Where does that go? What's the margin differential between T&D and others?
T&D revenues now in the coming year will be 80% plus for us. So you can say majority it will be T&D, and normally non-T&D revenue is about a couple of percentages lower than T&D. So that's where we are looking to go ahead.
All right. We missed the margin number. We would like you to give us a broad range. What can that look like? And you're saying there's scope for improvement on working capital days. Sharan, we love numbers. Give us a number. What should we work with?
I think on a net basis, on the working capital, we are at just about 90 days right now. we feel that there is scope to bring this down by another 10 to 15 days in the coming year itself. And in terms of margin guidance, of course, look, I would love this to become 12% overnight. However, long term, we do have an aspiration to get to 12%. Now, how soon we get there, again, it's a matter of time.
All right. You recently secured a multi-million-dollar order in the US as well. If you could give us some details around that. And also, the larger point, there is a fair amount of uncertainty for exports to the US. How much do they contribute to your overall revenues, and would the tariffs impact you?
Good question. Currently, the US is a very small portion of our order book and revenue. We have secured our first medium-sized order from there, and we are expecting larger inflows from that market. We don't see tariffs as a negative for us. Rather, we believe that the ongoing trade tensions between the US and China will open up further opportunities for players like us and for products like us, which are non-commodity and there are high amount of engineering and labor component. We certainly feel the opportunity is only growing for us long-term in the North American market.
So if you could give us some numbers around here as well, how much does US account for in your overall scheme right now? Because exports is just about 12% of your order book. You won some orders from the US. How do you intend to take that forward?
Let me put it this way, that currently our export order book is just about 12% of our overall order book. And obviously the US is a very, very insignificant portion of that. I'd like to club the US along with other developed markets where we are focused on, which is Europe and Australia. For our overall exports, the target is to take it up to 50% of our order book over the next 3 to 4 years. And out of that 50%, we would like 50% to come from these developed markets, which is North America, Europe, and Australia. So I'd like to give a guidance in that sense, and that is the opportunity that exists in all of these developed markets, thanks to the growth of renewable-led power transmission.
And if I remember correctly, these businesses from developed markets give you relatively better margins.
For sure.
Okay, all right. Let's wind this down then with a couple of more details. You have some capacity that's coming on stream, I think 75,000 tons or thereabouts. So do you believe that demand is strong enough to absorb this? Point number one. Point number two, what kind of capex number can you guide for the year? And the third point is, where does it take your debt to? So on the additional capacity, the capex and debt. Please go ahead.
Okay. So in terms of additional capacity, yes, we've done capex last year as well. So we have about 75,000 tons of new capacity coming online in Q1 this year. That will take our capacity to 375,000 tons. We are looking to add another 75,000 in this financial year, taking us up to 450,000. In terms of capex, we expect to spend similar amount what we spent last year in the range of 200 to 220 crores. And in terms of demand, we believe that there is a very, very long runway, and we are seeing the beginning of an investment super cycle in power transmission. So honestly, look, the market looks good for the next 10, 15, 20 years. We believe that even if we continue to grow, and our aspiration, as I mentioned earlier, is to become the largest manufacturer for T&D structures globally, which will happen over the next 3 to 4 years, we will see enough of a demand scenario over the next 10, 15 years to take care of this enhanced capacity.
What about your debt? Because your net debt is up nearly 31% from 440 crores to nearly 600 crores. Then you have around 220 crores of capex coming in as well this year. What happens to that? What's the deleveraging plan here?
I think what will happen is that, so again, we have strong cash flows to make to take care of whatever capex we are doing. If you look at our net debt number and add interest-bearing acceptances on that, then you would see that actually that there's been a reduction over last year. So compared to about 1,200 odd crores, we've actually brought it down to 1,100 crores for the net debt plus acceptances number. And like I said, that's come on the back of our improved working capital cycle. Further improvement will help in further deleveraging on an overall basis. In terms of long-term debt, we don't have a lot of long-term debt, so we're fairly comfortable, in terms of the debt equity that we are maintaining, which is below 0.6 right now.
And so comfortable on the debt aspect, do you see any need to raise some equity, capital Because I have my ear to the ground, and sometimes, the rumor is that maybe, in fact, Skipper could be looking at tapping the markets. Any truth, or do you want to downright deny it?
I would rather say that look, we don't have any urgent need for equity. As I mentioned, the company has strong cash flows and internal accruals to make sure that our growth plans are intact and they are comfortably met. At the same time, we're always open to good quality investors coming on board as part of our investor book. We have some good quality FIIs who are invested into the company today. And we're always open to inviting more and more good quality investors in the book.
Sharan, any conversation as of now? Have you received some interest? Say in the coming year, could we see some equity infusion?
No, I'm sorry. There's no nothing on the immediate horizon which I can share with you.
All right, take that point. Thank you so much, Sharan, for joining in and giving us those details. 25% revenue growth on a 41% base this year, with improving margins, the long-term target being 12%, currently around 10% as well, and capacity increasing over this year and the year after by almost 50%, something that we'll most definitely keep an eye out on. The stock up 7% on the back of those results. With that, we'll take a short break. In fact, before we do that, let's get you some ideas of profit coming in from our colleagues at Money Control Pro. Khushbu Rai of Money Control Pro joins in with a stock that she's tracking. Khushbu.
In today's idea for profit, we have Emami Limited. Emami is a market leader in cooling hair oil led by the Navratna range. The company is well placed to benefit from a favorable summer season supported by a strong rural rebound. The rural account for around 50% of the revenue and is a big volume driver. Emami's summer-centric portfolio, that is Navratna range and Dermicool, will likely drive strong volume growth in the coming quarters. The company has reported resilient performance amid the weak urban demand thanks to the better execution in the core business and favorable seasonality. The company is also expanding its non-seasonal portfolio through acquisition and brand extensions. Emami has also initiated robust strategy to revive the stressed brands. We believe that Emami's focus on execution to capture the rural growth recovery should be visible in the coming quarters. Further, it has a strong presence in the niche personal care categories with low penetration, which will likely drive demand in the medium term.
Let's take a short break. Come back on the other side. We have B. Vijay Kumar, who's the CMD of LG Balkrishna and Brothers, joining in to discuss their quarterly numbers. Stay with us.
Welcome back. Well, as promised, let's get straight to our next chat. We have LG Balkrishna and Brothers. The company reported a pretty subdued set of numbers actually in the past quarter. But what's the way ahead? To help us out, as always, we have Mr. Vijay Kumar, the CMD of LG Balkrishna. Hi, sir. Good morning, and always good to speak to you, sir. You've achieved a revenue growth of close to around 10% in the past year. For this year, what kind of a revenue growth could we look at? And also margins, well, they have been at around that 16% or thereabouts. So clear out both these two basic numbers first, revenue growth and margins.
Thank you for having me on your show. Good morning to all the viewers. And we've done exactly what we foresaw that we would do. For the future, we expect that we will continue the growth rate of 10%. And with the current scenario in the world, we expect that we will have an opportunity to grow up to maybe even 14%.
Okay. And margins, sir? Margins has been a little bit lower. I think you were targeting 17%. I think it's a little lower than that. Should this be the broad band?
Margin dropped 1% because of the American situation. Maybe going forward for one quarter, I foresee that there will be a further drop in margins, maybe another 1%. But it should pick up again in the second and third quarters.
All right, so margins should pick up again in the second and third quarter. I remember you telling us that, exports, which are 13% of your sales, continue to be a bit of a worry point for you. So, I mean, just trying to understand what is the kind of steps that you are taking to improve upon that. And a couple of triggers for you would be ramp up of LGB Steels and the industrial chains business. How much do they contribute to your business right now? And what's your target contribution from these businesses over the next couple of years, sir?
We've done about 30 crores in industrial chain. and we hope to do about 150 crores going forward. In steel, we've done 80 crores this year, the last quarter. We hope to do about 200 crores next year.
All right, so steel from 80 goes to 200 and chains goes from 30 to 150. What about exports? Where do they go next year?
Export, I would think that we will stay stagnant at what we are doing. I hope there won't be a drop. The American tariff has to also stabilize, because when America catches a cold, when coughs, we all catch a cold.
But this time around, sir, from a market perspective, actually, we had a cold first. So when America caught the cold, actually, we were getting better, at least from a stock market perspective. But normally, I think in a global scenario, I think that's the way it plays out. Let's focus on a couple of more aspects. EV, that's a segment that you've been looking at. What kind of a revenue contribution can we look at in FY26, FY27 as well?
I can't foresee any, I can't say anything about EV growth, because whatever we expect, it has not happened.
Okay.
And the growth in EV has been very big.
Yes.
The IC growth has been far more than what we projected. So I would not forecast anything for the EV growth. But
Okay.
we are ready with products for EV, like the gearbox and specialized chains. We are also concentrating on belts.
Yes.
So if it happens, we are there.
But as of now, there is no visibility.
There is not great visibility. The
And this
turnover is very small.
And this 10 to 14% revenue growth guidance that you're giving us, this includes both the segments, industrial chains, as well as the LGB steels?
Yes, all put together.
All put together. Got it. One more question with regard to replacement revenues. As a percentage of your total revenue mix, what is it?
It's about 32%.
Okay. There was a trigger that a higher replacement revenue would actually be better for you. So where would you like to take this number?
I think that will be flat. I don't expect any additional growth in percentages.
So aftermarket share remains between 30 to 32%. And what about the new facility? I mean, you did speak about the RGB steels. You spoke about the industrial chains business as well. What about any other new capex that you are planning?
We've spent about 50 crores on acquisition of property in Bagal, Haryana. And we will be moving one of the plants in Haryana, that is Manesar, to this facility. This facility will be about 200,000 square feet, and Manesar at this moment of time is about 50,000 square feet. So this will be moved to the bigger facility, because we expect better demand. We need to put in more machines, and that will be a separate project by itself.
Got it. All right. Mr. Vijay Kumar, when we have spoken in the past, you had told us that the promoter holding, you look at upping that. It's been steady for the last few quarters in that ballpark 34-35%. In the coming year, should we expect the promoter holding to move gradually towards that 40% odd mark? If yes, how do you do it? Will you do a preference or will you buy from the open market?
I don't think we'll do another preference right now, though the window for preference is open. We have to study, and then we would like to look at the market conditions and then decide.
What about the transmission and metal forming mix? Where do you expect that mix to be going forward? I remember that being around 80 to 20%.
That's going to remain the same. It's going to be flat.
All right. And what proportion of your business growth, how will that, correlate with the growth in the automobile industry itself, in the two-wheeler industry, the motorcycle industry, so to say?
Yeah, we will match the same growth.
You will match the same growth, no further or no lower than that?
No.
All right. Thank you so much for joining in and giving us all those details for the next year. Margins around the similar vicinity, maybe some improvement towards the second half of this year. with a 10 to 14% sort of revenue growth coming in, 30 to 32% in the aftermarket sales, and more importantly, growth coming in from their chain business as well as their steel business is what LG Balkrishna is talking about next year. With that, we'll step into a short break. As we do that, here's a small programming note for all you viewers. CNBC-TV18 and HSBC are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and shaping the future. Nominations are now open. What you can do is scan the code and submit your entry for the SME Champion Awards Season 2. The markets come off a little bit. When we started the show, Nifty was above 24,500. Now it's 24,450 itself. JSW Steel, Bharti Airtel and Bajaj Auto are the ones which have taken a bit of a knockdown. We have Kotak Mahindra Bank as well, which is off the highs currently at the low point of trade. So we'll just keep an eye out on these stocks. But the one which is zooming ahead is Eternal. Reported a weakish set of numbers, but from the lows, the stock has actually rallied about 8%. So two things are happening in Zomato. One is that the food gross order value is growing at a lot slower clip than expected, and the margins are staying steady out there. The company is attributing this to the weakness that we're seeing in consumer sentiment itself. And add to that, the lack of delivery partners also impacted their business. During the quarter, they shut 19,000 restaurants as well. So that accounted for about 2 percentage points of their overall GOV growth in this quarter. But more importantly, Blinkit. If you look at that, quick commerce was supposed to be the valuation driver for the company. The GOV is compounding. It's grown at around 134% year on year and 21% quarter on quarter. That's higher than what the street was anticipating. But what's also higher is the losses. So the losses have ballooned to around 180 crores on the EBITDA, and that's because of a couple of factors. One, high competitive intensity. Secondly, higher cost of customer acquisition. And thirdly, the accelerated store expansion plan that the company is doing. Was there any sign of support coming in for the company? Well, not on the competition front. They said that it is only getting more intense and they will aggressively look to grow market share and not let short-term profitability goals come in the way. They've added 294 stores right now. They had the 2,000 store target for the next year, but it looks like they will do that in the middle of this year itself. So the street, I think, is liking the long-term aggressive approach as against the short-term profitability worries, which is why the stock is recovered from the lows. But remember, it is still fairly off the highs.
All right, so that's a stock that's seen a big recovery from the day's low, but in fact, from the recent high, it's still off. Just to highlight a few stocks before we wind down. Force Motors, it appears that one's feeling the force. The stock is now up close to around 10%. We had highlighted this in our mid-cap microscope piece, that this is the focus on premiumization theme. For the time being, big volumes. I'm not sure whether there is any news flow. The stock has now moved up close to around 11% or thereabouts. A couple of other notable movers. Sonata Software. Remember, they get most of their revenues from Microsoft. And in fact, Microsoft's numbers are fairly good. The stock saw a big surge, ending Wednesday session 10% higher. Today, it opened up in the red, but it spiked up yet again. So that's another stock that I'm looking at. And Tejas Networks. The stock has got absolutely beaten out of shape. I think it's down more than 15% in this week itself. It's trying to find some kind of stability. It appears there is some kind of absorption of that selling, and that's why from the day's low, the stock is up close to 3%. We'll wrap up on this edition of Chartbusters. Stay with us. Trading Hour comes up next.